Hello everybody, my name is Ty Bernicke and I'm going to be going over One Big Beautiful Bill Act tax implications, and there's a million things in this bill, but I'm just going to be going over some of the higher level things that I think will affect many people. And one of the major items out there is state and local tax deduction, also known as SALT. And that has been raised from $10,000 to $40,000 annually until the year 2030, starting next year. And this is applicable for people who have under a $500,000 of modified adjusted gross income. So if you have under $500,000 worth of modified adjusted gross income, you can expect to receive some beneficial tax deductions if you have state and local taxes that exceed the $10,000 that was previously allowed for deductions. A few other major items to consider is if you are a single individual, 65 years of age or older, and you have less than $150,000 worth of modified adjusted gross income, you will get an additional tax deduction. And if you're married and filing a joint tax return, you'll get $12,000 worth of tax deductions. And the reason why you get this is it was generally made to offset some of the, made to negate some of the taxes that many people pay on their present Social Security. So this was kind of an indirect way to negate some of the tax liability that many people have to pay on their Social Security. In addition to that, if you're fortunate to have a larger estate, the estate tax threshold has been permanently increased from $15 million to $15 million if you're single, up to $30 million if you're married. And this is adjusted for inflation on an annual basis. So there's been a lot of concern with some of our higher net worth clients that this law might not be made permanent, and they might even drop the estate tax exemption. But if you're married and you have less than 30 million, you don't have to worry about estate taxes for the foreseeable future. And of course, if you are above that limit, there are a number of different estate tax planning strategies that can be used to negate estate taxes in the future, but this law was made permanent. Another thing that I think is worthwhile to note is that the debt ceiling with OBBBA Act has been increased to $5 trillion. And for those of you who have been following the situation with the United States, the debt to GDP ratio currently is about as high as it's ever been, and it's projected to continue to go higher. So if you're worried that because of this higher debt to GDP ratio, we'll likely see higher taxes down the road, one thing that you can do is you can convert IRAs to Roth IRAs. As you know, IRAs are subject to future taxation, but if you convert an IRA to a Roth IRA, you don't have to worry about taxes on the Roth IRA. This really only makes sense if you're going to be facing higher tax rates in the future than what you are when the conversion takes place. So the theory is if you can convert an IRA today at a lower tax rate than what you'll pay in the future, it can make sense. So Roth conversions have already been something that a lot of financial advisors from all over the country talk about. And I actually believe today it's even more promising for many people than it was previously, just because of the threat of potentially increasing tax rates in the future. Hopefully I gave you just a few things to think about with the OBBBA Act and things that actionable items as to how this will affect you and what you can do. Again, those are just some of the higher level items that affect the most people that are either going to be retiring within 5 years or who are already retired. If you have any questions on what I went over today and you'd like to schedule a quick call, you can click the link in the description below or go to our website at bernicke.com. Thank you.